So at Buzzercot, we're actually an accounting firm to do all kind of financial support, from R&D tax credits through to tax structuring, right through to just completing your day-to-day compliance for, we do work with a lot of FCA companies and their regulations there. Where I sit, though, is in corporate finance. What that is, actually, we've discussed this before, is we advise companies on raising finance. We're not a broker, although we do introduce people to investors. But the value we bring isn't about making a connection, because in all reality, people can go and find investors. It's not easy, but it's possible, and it's not a secret dark art. I'll explain a bit more in a bit. But what we actually do is we sit with founders from the start point of working out, A, do they need to raise? If they need to raise, how much do they need to raise? What impact might that have on their business? What are all the factors they need to consider? Then go out and build up a proposition that is interesting to investors. We'll touch on some of these points, but what I think there's some of the nuances that perhaps sometimes people don't appreciate is you can't appeal to every investor in the world. High growth investors are looking for high risk. If you present to them a plan that actually in 5 years' time you'll be making £5 million profit, and you'll be doing off that £25 million of revenue, they'll kind of go, you're not ambitious enough, I'm out. But actually, the other end of the market, there'll be a lot of investors who look at that and go, these guys are really sensible, they've got their head screwed on, they're not trying to be ridiculous and burn through loads of cash, we really like them. And therefore, so it's fine, it's doing things like that and working through that process to work out what's your pitch to people, and then just making sure everyone's on top of actually what's the business doing. Lots of metrics that we can talk about if people are interested or not. Lifetime value, cost of acquiring a customer, how does that all work out? Working out your unit economics and everything like that to actually make a full presentation. So we help build pitch decks and financial models with people. We then do take them to market and introduce them to investors. There are certain things which we'll definitely touch upon in a bit, which is around tax efficient investments. So people in the room may already have EIS money. One or two may have money from VCT funds. Actually understanding if you qualify for that or not is very important, because a decent portion of the market in the UK actually is looking for that. When you hit certain scales and if you're circling to certain parts of the market, it's less relevant. So it's understanding, again, who can you talk to and what does that mean in terms of what you should be presenting. Then go and have all the conversations, and then gets into the really fun bit, which is where I jumped out of the room on the call briefly there, is when you've got investors and you're talking with them in terms of deal terms. As I mentioned to a couple of people earlier, having for argument's sake, a £7 million valuation sometimes could actually be much better than having a £10 million valuation. And it's understanding that and everything else that comes with the investment agreement, right then through to making sure the thing actually closed. Because, again, what people generally don't realise is when you've signed a term sheet doesn't mean you're getting the money. It means that you've shaken hands, but they can pull out at any time. So it's making sure that actually goes through and you get the money in your bank account. That's what we do. We work with companies looking to raise £2 million plus. So everyone has their own definitions, but Series A onwards. We also then work with companies who are mature, profitable businesses that are looking to exit. There we work with businesses looking to sell up to about £100 million value. A couple of deals doing live right now. So one I touched on there, we've got a company that's raising £3 million. They should be signing their term sheet today, fingers touch wood. And we've got another company we're talking to private equity around. They probably they're doing a partial cash out. The founder wants to take about £8 million off the table, and then get a couple of extra £1 million into the business to complete some acquisitions and things like that before he wants to grow it into 50, 100, 200 million pound business. And that's the plan there. So it gives you a couple of ideas of products we've got on the go at the moment. Hopefully that's clear. Anybody got any questions on that? Otherwise, I'm happy to jump in. I will get out James's email just to make sure I'm covering everything you guys want. What I think I will start with, though, is talking about tax-efficient investment, because actually I think a lot of people don't necessarily realise the importance. They may understand it from doing a seed round, so hands up if people have done seed round and taken somebody who's EIS investor before. It's a decent number of you. For those who may or may not know around it, quite simply, these are government schemes. The government put them in to encourage more investment into early stage businesses. If I'm an investor and I've got £100,000, I put it into a business. I wish I did, I don't. put it into a business, you get £30,000 or $50,000 if it's SIS back as a tax relief. Therefore, it's a really good incentive for me to invest into early stage businesses. If that business doesn't make it, I can actually get them further losses in the future. So I never remember the exact percentage, but you kind of go down to like 15% exposure effectively on your investment. So it's a really good scheme. The reason I bring it up now is not only is it great at seed stage when you're talking to individuals, angels, a lot of the more prolific investors in London actually are tax efficient investors. So they're pooling up individuals' monies under an EIS or a VCT fund, and then they're putting it into businesses. So probably most businesses in the room will count. As long as you're a trading business, you're not doing anything where you're buying property or you're a fund yourself or things like that. There are certain restricted activities. Most businesses will qualify. However, there are certain criteria. So, for example, the one we find people falling foul of most is the age of the business. So, if you're under 7 years, you can sometimes get it more. If you're under 7 years old, generally you'll be fine. If you're older than that, it becomes really difficult. Now, again, there are other ways around it, but it's things like actually having taken some EIS money in the past means you can still qualify for tax efficient statement in the future, as long as you say the right things at that time. So sometimes I actually say to people it's worth getting 10 grand of EIS, saying this is a precursor to us doing a bigger round in the future because you help protect your tax efficient statement. Now, you may never use that, but actually that's really important. So when we get businesses coming to us who are looking to raise, depending on what type of investor they're targeting, these guys are probably on the more low risk but more guaranteed return side of the spectrum versus perhaps people have heard of Excel Index, Balderton in the world, who are looking for the next unicorn, and if you've not got a chance of being the next unicorn, they're not interested in you, basically, is as simple as it works. Whereas the guys, maybe you're in a smaller market size or you just don't want to burn loads of money to try and become a billion-dollar company, those smaller guys that when we speak to businesses, if a company is over 7 years old and they've not taken it before, we kind of say it's going to be very difficult because you've taken a pool of investors in the country from that down to a pool of investors like that. So it's not impossible, but you've taken out, I don't know what the percentage is, but you've taken out at least 50% of the market probably in terms of deal volume straight from the outset. So thinking around things like, and just having an awareness is important. I said, a number of you, if you're early stage businesses, you're young, you've raised EIS money before, you're doing something properly that's trading, you'll probably be fine, but it's just something that's always worth having in the back of the mind because there's no point in losing yourself part of the market. So you definitely cannot have anyone who is a founder, an employee. It's really risky if you do someone who's highly connected as well, doing EIS, they're excluded. If you have an investor who put their money in as a third-party investor early on, and then they became a director of the company to oversee their investment and all that kind of thing, that's fine. If you made them an employee, that could risk their tax efficient status. And it's also worth saying, technically, the risk is on the person, not the company. But obviously, as a company, you have a duty of good care to your investors. And if you think that's a problem, you should talk to them about it. But it's not a charge that technically would sit on the company. It's something that's going to risk for your investors, which is why, again, when you get to, if you're at Series A and you're dealing with a tax efficient investor, it's in the term sheet we're looking at right now. One of the conditions in there is subject to getting approval from HMRC that this investment is tax efficient. If that doesn't happen, they can't put their money in, and they won't put their money in. So they're trying to protect themselves from that point of view. Being honest, existing traction is almost 100% better than a new demo product. New demo product is great. It shows upside, it shows possibility. But when you're talking around Series A investors, there's a unwritten but often said rule that they want £1 million run rate revenue and decent growth getting to that before they'll have a look at investing. Now, there are always exceptions to the rule. An ex-colleague of mine I've been working with, they had a company and an idea and they raised 2.5 million straight off the bat. But reasons for that, because the founder had exited a business for £100 million previously, so there's track record and everything there. What investors generally are looking for is they want some level of traction and track record. Having a new product, a new idea is great, but effectively what I'd say is if you're talking about that within a more existing business, view that effectively you're asking somebody to make a seed stage investment when actually you might be talking to a Series A fund because you've got a more mature business. You need to talk to them as the Series A fund, but then what you're doing is you're offering them a bit of blue sky opportunity that everything in investment is risk reward. So you're offering something high risk, as mentioned before, but actually it might be really high reward. So you sell it them as this high reward, but what you're really doing to make sure the investment comes through is you're selling a business that has traction, which is lower risk. And therefore, they've got this opportunity for high risk, but there's something low risk. So that's where it works and it's helpful. Don't get me wrong, definitely mention, if you've got a new product and an opportunity, mention it. But the mistake I sometimes see people do is they actually might have a business that's doing a couple of million of revenue and they've got a new product. And we actually had this with a client of mine previously, and it's trying to strike the right balance, is the whole deck talks about the new thing and then at the end mentions, oh, by the way, this is part of XYZ Limited, which has 2 million of revenue. And then everyone looks at that and go, no, I'm not investing into this new product here. Whereas if you sold it as XYZ business, it's doing really well, and look, we've got this great new opportunity we're looking to explore, that actually then is a much better investment proposition. So it's all about trying to nuance your presentation there. First off, I said earlier about everyone has different definitions. Generally, I'd say kind of forget, the thing to think about is how much you're trying to raise. That kind of puts you into A level. Now you can put broad classifications on it, but Series A is a lot more defined because companies will be more mature. You can kind of throw more of a blanket over them. The earlier stage it gets, the more variable it is. The way I often describe it is as you get more mature as a business, you kind of go through a funnel that gets like this. It probably does widen out slightly towards the end for reasons we won't go into now. But if you're talking about, as I mentioned, my ex-colleague earning £2.5 million, that scenario there is in that high level of variability because nothing exists. It's just, do people believe in an idea? Often the earlier stage you're going to be dealing more with individuals. There are seed stage funds. There aren't as many seed stage funds as there are Series A funds because, coming back to the reason, we don't work below £2 million because it's not, I'll be honest, not economical for us. That's the problem that a lot of the seed stage investors do. So what they're doing is they're not going to do the same level of due diligence. They're not going to look at businesses as hard. They're going to often be more of the kind of the portfolio play. So if I bucket investors into two pots, and it's not two pots, it's very much a scale, but there are those who are making a portfolio play. What they're doing is they're betting at the roulette table and they're betting on green every time. But if green comes off, it pays great for them. That's what they're trying to do. So they're maybe making 20 investments. They expect one to come off, but that investment needs to deliver them minimum 10, but really 100x. That's what they're looking for. But then that pays for everything else, because most of those may actually go bust and not return any money. A couple might do okay, and one or two might just clean their face in terms of returning the money to the investor. The rest of it they don't really care about. They care about that one. That's what they really care about. Through to then other investors they may make the same 20 investments, but it really hurts them if one goes bust, but they know one or two will. They'll have a number that will wash their face, and then they'll have maybe 7 out of those that will make a decent return and 1 or 2 that will be really good returns. Those will probably come back to similar overall returns for the fund. It's just a very different scenario. So these guys over here can't afford to make errors, and therefore they'll look at things harder. These guys over here with a portfolio, what they're looking at more is market. So if you go to them and say, my market size is 500 million, that's not bad. You can build a £50 million business quite easily within that could be making £10 million of profit that's worth 50, 100 million pounds. That's great, plenty. That's a really good business. However, those investors are not interested in that. They need you to be saying, our market size is 10, 100 billion, and we could easily get to $1 billion of revenue, no sweat whatsoever. Actually, we could potentially get to 10, and that's what they're looking for. So when you get to seed stage, it's not perfect, but you probably find people doing a little bit more of that because they haven't got the time to spend really analysing a company. So they just kind of go, thematically, this investment makes sense, this market makes sense, these guys seem like good guys and maybe know what they're doing, we'll make an investment. Whereas when you get a bit more mature, people can spend a bit more time looking at it, and therefore you'll get a few more of these investors coming over here. So I said, everyone will have a different leaning. If you're somebody who sits here and goes, what's the point of me doing this unless I'm going to create a world-changing business? You want to be talking to Excels, Bulletins, indexes of the world. Those are the ones. As long as you make sure you're in the right market that's big enough it's growing, it's attractive, it's sexy, that kind of side of things. If you're somebody who sits here and goes, do you know what, I've spent the last 2, 5, 10 years of my life building something, I'd hate for me to end up with nothing, and do you know what, I'd be over the moon if I got 30, 50 million pounds out of this, you then fit into that pot. And I said, it's not perfect, it's a spectrum, so there's people there, but it's also analysing where you are. Roundabout way of coming back to where you are, more of them are at the seed stage, so it's more variable what they'll look at because they're not doing the same kind of level. You're also dealing with a lot of individuals. When you deal with individuals, who knows, all you need to do is you need to find the one idiot who's happy to put money into, and I don't mean it in a negative way about his business, but if you find an idiot, they give you a silly valuation, they give you lots of money without really checking it, and they're happy, and that's great for you if you find that person. The problem is that's the needle in the haystack. We'd all love to find that person, but there aren't many of them around. So that's I suppose a bit of an overview, and the answer there is there's not a perfect answer at seed stage. It's very variable, and another part of the reason we don't operate in that side of it. But what I'd say is for seeds, as a rule of thumb, you might well be able to go and raise some money if you've got a good idea, you're credible with a product. It becomes much easier with revenue, but that's the same as I could say at any stage. The more revenue you've got, the better your growth rate, the better the chances you've got of raising money. It's not rocket science in that respect, I'm afraid. B2B is probably easier to raise for as a first point of view. Investors like it for a couple of reasons. They like recurring revenue. Most B2B businesses will probably have some level of recurring revenue. Coming back to this traction point, if you've got a £100,000 product, let's just say for argument's sake, and you've sold that to HP, Siemens and Dell, you can probably sell that to Microsoft, Google, Apple as well, because you've got enough proof points. The challenge that investors find with B2C is we all know you get early adopters to things. So you might well have got to 100,000 users quite quickly, but are those people, is that actually your full market size, and those are the people that are actually always going to use your app? Or actually, can you make this into 1 million or whatever the number needs to be? So it's a bit less dependable. So therefore you will find, coming back to this market overview, actually within that, if you're B2C, you're probably dealing with a slightly smaller subset of investors who will look at B2C versus B2B. There are more B2B only funds out there than there are B2C only funds. If you're B2C, probably dealing with somebody who has made B2C investments before makes sense because they understand the market and the risk profile a bit more, and therefore are more likely to invest, whereas somebody who perhaps hasn't might get a bit more spooked by it. It's not saying if you're B2C you can't raise at all, but I'm just saying business models, investors do lean towards B2B SaaS businesses. That's the kind of business they really like. Cool. I'll move on to the next question when my phone unlocks and hopefully has lost the page.
Your 2 million figure, did you say it was nothing less than a 2 million raise?
Yes, for us, yes. And I'll be open about that. We take a percentage of the raise. Therefore, if we're raising £500,000, the risk of it going through and the amount of time we spend working on it, it just doesn't work. But therefore, equally, us doing a £5 million raise, we're probably not going to charge the same rate as we would a £2 million raise because the work isn't tremendously different between that. But that's kind of our rule and how we operate. Below that point, there are advisors out there who'll do it. I would say probably the quality is highly variable. So just be aware of that. There are a number of... Unfortunately, we're in an industry... it's almost a little bit like estate agents. There are a lot, you don't technically need any qualifications. So me and Hamish are both qualified chartered accountants. We've been doing this for a while. But there are a number of people you could just set up and go, I'll introduce you to XYZ and I'll take money. And that happens. So it's just being careful. If you do, just kind of make sure people seem to be some sort of professional outfit, at least if you are going to use advisors that kind of stage, because there are people out there who will do that. I will say that kind of as a caveat. I'm happy to say some names of funds that are quite good. A lot of these, again, a number of these also be tax efficient, but they're Mercia, tax efficient. FSC, which is Finance Southeast, is not tax efficient. Well, is and isn't tax efficient in terms of what they'll do. You've got people like Passion Capital, They've been in one of my clients and have been pretty supportive and good. If you're B2C, you've got Jam Jar, who are looking at brands. You've got Local Globe, who very much fit into that. If you look at how they'll probably distribute, a lot of their investments will be looking at the Excel and indexes later on, whereas maybe somebody like Mercia, not saying they won't ever, but maybe they'll trend a bit more towards some of the VCT funds later on, as a kind of, I suppose, giving you the risk profiles of what they'll look at. Trying to think off the top of my head, who else is Deep Bridge, Downing actually. So we deal with Downing in terms of Series A, but they've started doing some more earlier stage stuff and seed. Coming back to the introduction point, be honest, Google seed stage investors, you'll get a list. Google EIS funds, you'll get a list of them. You can find lists of people. The trick is not everyone's active as much as others. Coming back to the EIS point, they're only probably 15, 20 tax efficient Series A investors. But the thing is, each one of those is probably doing 10 investments a year. So that's a lot of investments they're putting out there. Whereas you might get some other people, and you hear the scenario of, I don't know, maybe it's actually a corporate just taking a stake in a business, but they may do that once a year. They may do that once every 5 years. So suddenly, if you think of your deal volume, they're doing a lot of deals, even though there aren't loads of them. There's a much longer list. There's thousands of investment funds that will look to invest in the UK. But actually, how many investments are they actually doing? Therefore, is it worth spending your time talking to them? You just want to talk to the guys probably who are doing the most stuff. No problem. Any other questions on anything I've just said there? Otherwise, I'll move on to the next point. Somebody else. How do you identify the right VC? Some look at profit, while others look at big data. Coming back to it, I've talked about in terms of, I suppose, risk profiles I look at. I've touched on sectors, so some will be sector specific, some will be agnostic. The thing I will say, and I had a debate with my client about this yesterday, is my view is when you're talking to investors, people talk about dumb money and smart money. I always say take dumb money, as long as it's not too dumb that it's going to be obstructive. The reason for that is because we were talking about crowdfunding. You might well get a higher valuation than you should, which means you retain more of the company. That's great. Reason people want to go and talk to smart money is they think it could bring loads of value. Actually, what I'd argue is if you're getting a slightly better deal on it, then actually it means maybe you could take £500,000 more. With that £500,000 more, you could hire 5 senior managers who are top quality. You're getting one guy on your board who might seen a bit, but actually his first and foremost job is an investor. Those 5 guys should be far more productive for you than that person. So the value, you're much better to take more money, buy in the expertise. You control that expertise. You're empowered. If it's not working for you, get rid of it. If you're getting an investor on, and they might have the best intention in the world of, do you know what, actually, some of them sell themselves as, some investors come and say, we're going to give you money, we'll sit on the board and we'll challenge you, but that's what we'll do, and we're not going to involve day to day. Some will say, do you know what, we've got some team of guys, we've got in-house recruiters, we've got in-house tech guys, they'll come in, they'll help you with all this. That's great, because inverted commas, it's free, maybe, but it's not free because you pay for it, because they take management fees. They're not going to give you something for free. Their job is to make money. Ultimately, that's what you have to remember. Their job is to make money, so they're making money somewhere out of doing that. Now, that could be because you're becoming more valuable and therefore they're making more return at the back end, but they do still charge for that because they need to keep the lights on in the meanwhile. The other point about it is how much they promise. There's no guarantee. Once the money's in, they can do what they want, within the agreements you've drawn up with them. And I'm not saying that they'll deliberately then say they'll offer you the world and will help you do this, and they won't deliberately. But equally, at the same time, they may just get... So if we're talking about those that are the portfolio, in reality, who are they going to spend their time on? They're going to spend it on the time of the company that's really struggling and needs help, or they're going to spend their time on the one that's going great guns is going to give them the return. They're going to spend it on the one that's going great guns and giving them a return. So if you are not that one, they're not going to give you as much support, which might work for you because you're not got somebody who's overlooking you the whole time. But it's worth considering that. Whereas if you take money, if that person's not delivering, you get rid of them, you hire somebody else. So I always say take more money to hire in the expertise rather than like, if you've got 2 identical offers and one is really clever, they're going to add some value and somebody isn't, well, go with the guy who's going to add some value, obviously. But don't necessarily take a worse deal because of that. And so let me give you a direct quote from one of my clients. Dumb money's not fair, but they took money without any expertise. And the investor was very clear, we're investors, we're financial people, that's what we're going to do. And so my client says, it's a bit painful because they still don't really understand our business model. So every time we're at a board meeting, we kind of have to explain things to them again. But actually, that's great for us because we got the money and we can do what we want in the meantime because they're not sticking their nose in the whole time. So we have a meeting every 2 months and it's painful, but that's the price we pay for getting that. Now, I said, that's not going to suit everyone. People might well want to go into this loving embrace of an investor who's got this community and everything like that. To be honest, coming back to the same point, you can come and join the Founder Network and become part of a community. There are things you can do to replace all that. So again, everyone will have their own different things, and there is no right VC. There's a right VC for you. So it's before you going, this is part of what we do again, it's sitting down with entrepreneurs. Often they kind of get to the point of, and this is not a criticism of any entrepreneur, but you concentrate on running your business, you go, I need to raise money. I'll do it now. Because you're used to, in your business, trying to run at things, solve problems, because you can't go and analyse something for 12 months and see if it's going to work or not. So you sit there and you kind of, well, I'm raising money now, so I'm in raising money mode. It's taking a little bit of a breath and going, right, what do I really want? How much is it? Because if I take more money, it's going to cost me more money in the long run. But actually, a lot of the challenges entrepreneurs face are they take too little money and then they come back later on because they've run out, they spent it quicker than they thought, because they've under-egged a cost, or again, a client of mine, opportunity arose, one of their competitors wasn't going very well, was really struggling, and they raised £3 million to hire salespeople, but actually they managed to get a whole sales team from this company where everyone was disenfranchised at the same time. But that was 12 people. Rather than taking those over the course of the year, they took them immediately. Obviously, that costs money. So they got towards the end. And there are other things you can do that reduce dilution that people might not be aware of. So there's venture debt. I don't know if anybody's aware of that in the room, but there are two types of that. There are venture debt who will just be pure debt and sometimes might come in and replace capital. Now, you're only going to get that definitely Series A beyond. You need to show a level of traction and they need to be comfortable you can repay it, and you can't be burning millions of pounds a year because they won't lend you that. But if you're a business who's, I'm break even, I've got a couple of million of revenue, I've been growing well, you could potentially go and get debt rather than equity. If you grow, it's cheaper, it comes with different challenges and problems, but it's an opportunity. Or there's venture debt, which is, I've raised £3 million. They might give you, because they know if you're struggling, the investors might bail you out. They'll give you £1 million as debt, and you've got then this extra buffer. The other trick they do, though, is that they have a covenant in there on that basically says you always need to have £500,000 left in the bank. So you need to recognise you're only getting £500,000 and paying interest on £1 million, and also you're paying interest for all the time you're spending your investors' money right there. But it's often can work out cheaper than going back to your investor with your hands in your pocket going, I've run out of money in 18 months' time, and you need to get another £1 million out of them. And they go, well, but this isn't really what you told us. We'll give you the money, but we're probably going to have to come in at a lower rate, a lower valuation, because you're not doing as well. So it gives you that bit more level of control. So I'm not advocating it, but I'm saying it's a possibility and it's an option. Again, it won't suit every business. It'll suit some.
And also, they need to see some forward orders or some
they need to, yeah.
take agreements.
To your question previously, B2B SaaS businesses, they love because there's security of revenue going forward. Something that is very transactional, they won't, because if it drops off a cliff, there's nothing for them to secure against. So again, they'll have different preferences, and they're looking the same way as an investor will as well. So while you can't change your business model, what sometimes people will do in talking about new products is, if people are more transactional, sometimes they might try and, we're going to put in something that's more SaaS because we really couldn't get any investors until we did that, and they'll create a new product. If that works, great, because you've made something more attractive to investors, but don't necessarily always fundamentally change your business model to suit investors. If you can get there without, the one thing I've not said is, if you can get there without an investor, you're in a way better position because you own 100% your company, you've got 100% control, you decide when you sell, you decide what you sell for, you decide if you ever sell. That's much. Now, obviously, that's the very hard route. It's also slower, so if you're moving on a first mover advantage, then actually somebody could easily overtake you. You know, look at all the examples through history, MySpace, etc. People get overtaken the whole time. But if you can create a successful business without any extra capital going in, you're in a better position. So that's the one thing I think also people get onto they get funding as a drug, and I think, well, I need to raise. Everyone's raising. I need to raise. Again, a first challenge. We don't make money if people don't raise, but the first question always goes, do you actually want to raise? And if people are certain of that, then great, go for it. But make sure you've had that thought process. Again, they're in the business of making money. They want to give you money when you don't need money, so you pay them for that. They're prepared, obviously, you're going to use some of that money because otherwise, why are you asking for it from them? So they're prepared you're going to spend some of it. But the worst thing you can do is, oh, actually, we're not sure we're going to need it. You get to the end of 18 months, you've spent all your money, you've got £2 left in the bank, and you go to somebody, oh, can I borrow some money? No, that's going to be the response you're going to get. So it's more the way to think about it is, you should come up with your number being we have got a buffer in there that we're maybe taking a little bit too much. Because even though, okay, if we grew great and we got more money in the future, we might get a higher valuation, there's a risk you won't get there. So I'd always say probably take a little bit too much, even though, okay, you've diluted yourself a bit more. The bit with debt to think of is, could you replace some of that without being diluted so you own a bit more of the business? That's the way to think about it. Don't think of the debt as your contingency. Think of your debt as a mechanism, if that's what you care about, and I say it brings different behaviours to reduce the amount of dilution you've got, versus actually versus just saying it's my contingency. Your round should be your contingency in itself. So we look at similar bases to investors. So we probably don't go to quite the same level of in-depth in terms of due diligence and everything, but we will find that out over the course of working with people because we'll be preparing. Look, if somebody comes to us and they're doing 200k of revenue and want to raise £5 million, I'll probably politely just say it's not impossible, but it's highly unlikely. It's not we can't take the risk on doing that.
Annual or monthly?
Sorry? Annual. If you're doing 200k monthly, you're in. But if you're doing if you're doing 200k monthly and you come to me and say I want to raise £10 million, I'm probably going, you're probably not going to. Again, you might. There's always I need to always caveat in what we do. In this world, there's always exceptions to the rule. But generally, yes, that's going to be tough. So we look at it on the same kind of basis. We think, does this company have a chance of getting funded? Is there a fit with the founders? We don't take and investors will do this as well. We don't take some businesses on if we don't think we can work with the founder. Then we're not going to do it. We want to have a good relationship that's productive. Being honest, the amount of money we make by doing a fundraising is nowhere near the same as we do get from doing a sale. So actually, we want to work with businesses over a long course of time. So one of my clients took money 2.5 years ago or so, and they've come back to us once to get some debt. They're probably going to sell in the next couple of years or take another chunk of money and replace the existing investor. We're there to work with them over that long course of time rather than actually just being... So most investors, again, and everyone's different, but they will have a time horizon. So the way they work is, and it's probably worth everyone understanding how they think about this generally, is there's a term called IRR. I don't know if a couple of people seem to have known that, which is internal rate of return. So a lot of the time, early stage businesses, because it's all uncertain, everyone talks around kind of multiples. So they'll talk about, right, well, if I go in at a £10 million valuation, that my fund is targeting 10x returns, therefore I need you to sell for 100 million. If you sell for 100 million next year, I've made that really difficult for myself now, but you've made 1,000% or whatever IRR in a year. If you do that over the course of 5 years, you've made 20%. Oh no, you've made 200% IRR. If you do that over 50 years, you've made 30% or something. So the time frame comes in to matter significantly. So therefore, what investors don't want to happen is a business shoots through, does that, and then starts doing that. But the founder goes, I don't want to exit this business. I don't want to sell it, and give the investor their money back so they can invest into another business here who's about to do that. So they will have terms and clauses in there which say after 4, 5, 6 years, we can sell your business, and if we decide to sell, you have to sell at the price.
Yeah, the investors generally have that.
Yeah.
That's what I've seen.
Yeah. It's rare not to. Again, come back. If you've got a seed stage, investors might not.
Is you get someone to buy the investors out.
Yeah.
That's a way around that.
Yeah. So you could. So what they care about is they care about getting their return on money. The problem is there's no guarantee that can work because you have to find the person who's willing to buy them out and believes in your next story of growth. You need to have obviously grown during that time for it to be appealing. And then equally, the textbook, it's not the case right now, I would say, in the market, but the textbook says a trade buyer, so a company, should pay more money for you than somebody who's a pure financial buyer. A trade company will not buy out just an investor because they'll buy the whole company. And the reason for that is because they get synergy. So let's try and think of an example. A really good example might be Google buying Waze. So Google had their maps. They bought Waze for all the users and everything, the value that was there. But the other incremental value they had was, I'm just going to pick, this is not the main reason, but a silly example would be they might have spent £2 million hiring all those engineers, probably more, just from scratch. They don't need to pay that anymore. So there's an example of a synergistic benefit. More realistic examples are if you've got two factories together, and then one's making I don't know. I know I'm making this difficult for myself now. But you've got two factories, and you just get rid of all the backroom staff because actually they can serve the two factories. Then actually that's a synergistic benefit. So the challenge is that trade buyers should pay more for you. So while you might go and say, oh, I found a lovely private equity house that's willing to come and buy your 40% of the business, and that gives you a 5 times return, they might still go, yeah, but let's go and see what the trade buyers want to pay us because they might actually give me a 10 times return. So they want to go and have that conversation. Now, if you don't find any better, there's a good chance you might be able to get them to be bought out because that's a good opportunity for them to get a return and leave the business. But there's no guarantee. But that's a reason, an opportunity. There's something called we're now stretching away from funding, but there's something called an MBO. Again, I don't know how people in the room know about that, but that's where the management team are not necessarily the shareholders of the company. And that management team, because they're running the company, kind of go, we want to own this company and benefit from all our work. They know what the true value is. So what they want to do is they want to buy the company. They'll get a private equity sponsor in who will buy part of that company, give some to the management team, that kind of scenario. You're basically doing a management buyout at that stage because you're the management of the business. You probably still own some, but an investor owns a portion. What you're getting is you're getting a third party to help you buy out that investor so the management own more of it, or at least you're keeping your stake in it. Kind of. But I'll be honest, there isn't that much patient capital. Wherever everyone says...
They say it, though.
They say it. And there are different fund structures, so I don't want to get too technical, but you get funds which are evergreen, so there's always money in them. They should, in theory, be more patient, but again, coming back to it, if you're not, they're not going to keep holding investment if it's not making the return. Why would they? Well, they may if they don't want to show it on a blot on their copybook yet. So again, there's all sorts of reasons. But there are funds which are closed-ended funds, and therefore, if it's a 7-year fund, they have to sell you within 7 years because they're going to have to return the money to their investors. Otherwise, they'll incur penalties. So it's worth considering that. Often a question people won't ask is, what kind of fund are you? When's your fund closed down? If you're investing and they've got 3 years left, then you kind of know what that means. And again, this comes back to it. Everyone will have different views. Some people will be like, do you know what, great, I want to be in it for the next 3 years and I don't want to spend any more time after that. Wherever we've got to, we've got to. Other people go, I'm in this for the next 20 years. You want to try and find somebody who's more aligned to that. It's very rare. Whatever they say is very rare an investor will be there for that long unless you are a Deliveroo or somebody who's keep doing that. I would say female-led companies are rare. And I don't know what the cause is. I don't know whether it's opportunities are less at the early stage for getting funding and opportunities there, whether it's fewer women become entrepreneurs in the first place, whether it's a combination of all that. There are fewer female-led companies going for Series A. There are stats out there, I can't remember what they are, but it's like 90% or something of rounds of male-led teams. Maybe not all male, but male-led teams. Yeah, 97. So the thing you will also find is it's changing. And I know, talking to an investor friend of mine, they were hiring somebody recently. a lot of the investors you'll talk to, there's terms that fly around, pale, male, and stale. There are a number of investors who are like that. It's male-led still investment, generally white male-led. But having spoken to somebody, they're aware of that and trying to change it to an extent. They were saying we're hiring somebody into teams at the moment, but actually the last 2 people we've hired were male. We know we need to hire a female. So there's more awareness becoming into the sector. I think the one advantage that female founders have is you then slightly become more of a commodity to readdress that balance. Now, not every investor will care about that, but there is a sometimes that actually you can become more of a commodity. But in terms of, I don't know if there are any psychological biases there. I'm sure we've all read books around you gravitate towards people who are similar to you, and therefore, even if you're consciously trying to avoid that, there are subconscious biases there. I don't know what there are, but it's a fact. The facts I can tell you are most teams going for investment are male-led, and most investment teams are male-led. Client, I said we're expecting a term sheet from today. They have social objectives written into their shareholders and articles. There are social first funds. Be honest with you, they're the minority at the moment. We once spoken to, the way it was looking, it's now looking at a slightly different deal structure, was we had a lead who was a pure financial investor, and we were going to have a follower who was a social impact fund. Because coming back to, there aren't as many that don't necessarily have the same check sizes yet, but they could write a smaller check to join in. The lead now wants to potentially do it all, so that's the discussion and why we're probably going to sign a term sheet today. But actually, even for the financial investor, having a social mission is positive. If you look, every company is doing more around CSR. It's a social factor that's there. The positive for them is a lot of these funds, well, all these funds have an investor in the background, and what they want to do is they need to sell to those investors to get them to put more money for the future, because that's how they make more money. The easiest way to do that is go, look, I'll make you loads of money, because that's a really easy sell. If somebody tells you, I'm going to put £1 in 5 years' time, I'm going to give you back 2, you go, that's pretty good. Yeah, I'll probably do that. And there's real evidence of why they'll do it. But actually, if they can also go, well, why, with that 2, Joe over there is offering you 2 as well, but actually my company, some of those have got a social angle, you've got something else. Comes back to the same point I'm saying, you've got 2 identical offers and one's got something they can add and somebody hasn't, you'll probably go with the person that's got something to add. It's the same thing for the investors. So it's a positive. You are something that they can use as marketing for your own. So realise it's a commodity. Just because you're social then doesn't mean you can't talk to a financial, because you've still got that. You're actually still positive over somebody who is pure profit. The treading the line, threading the needle thing is, in terms of talking around profit, if you go in and say, we're social, oh, and by the way, we'll make a profit, they'll be worried about that. What you need to do is you need to go and make a commercial pitch first, and then go, or not necessarily, oh, by the way, it's in the thread, and it's there, but it's making sure it's a commercial. Yeah, it's interwoven, but it's we're commercial, we're social. It's not, if you do it that way around, you'll probably turn most off. Even if we're being completely honest, not all, but even some of the social funds, if you went in too hard on that, you might turn them off, because they're a fund to make money, but they are restricted. Coming back to the restrictions that I've talked about in terms of talking to investors, what we have to realise also is certain funds that have restrictions on themselves in terms of they might be self-imposed, but we'll only do B2B or we'll only do social, means that actually there's a smaller pool of investments for them to talk to. And one of the big things that's out of the control of anyone in this room is how much deal flow is one of those investors seeing. If you're a social company and you're going to go to talk to the social investors, if they're seeing loads of social companies at that moment in time, you might be great and something they'd be interested in normally, but they might just pass you over because they've got other things that they're looking at and they haven't got enough time. If they've had 6 months and they've not seen a single business that was interesting to them, and then you come along and you're interesting, they'll be all over you because they haven't had that time. So that's out of your control, but it's also recognising that gets more it's more intense in a fund that has restrictions on it because they don't have the same breadth. if you're an agnostic fund that will invest in anything, probably their little bumps will be like that, whereas somebody else could be massively like that. So it's acknowledging as well that go and talk to the social funds, but they might work perfectly for you, they might not, and that might not even be your control as well.
If you're doing something with firearms, if you're doing something with gambling, if you're doing something,
Sex and firearms. No one's done that.
Sex, guns, and...
You notice everybody's running that down now.
Yeah.
What could go wrong?
Yeah. Russian roulette, I think that covers it all.
Yeah.
It comes back to the point I was saying before, these investors have to sell at the other end,
Yes.
and any reputational risk of their investing into, partially why they do diligence is if they're investing into the next Theranos or something, nobody else will invest in the future, so they have to be certain on that. But also, if they're investing into something that turns out to be a horrible, horrible company, it's using, children in Asia under slave conditions, that's not great. If they're doing something really obvious, like they're selling firearms to Islamic State or something, nobody's going to invest in that, obviously. It's because there's no reputational risk. Who's going to give them money to go and do that? So, there are certain sectors which are harder, but to be honest, they're the really obvious things. It's you might find one or two prudish investors, but I'll be honest, I don't think it's a negative. And actually, with some, it'll be a positive because coming back to it, it's interesting. So you're more likely having something around sex. You're probably more likely to get newspaper columns and inches in the future, right? Which is great for their investor because they can put that out there and people will talk about it, which is good for the investor. So actually, I'd say net positioning is probably positive for you. I can't talk about everyone's individual business in terms of, I suppose, as you're mentioning there, all the operational factors. I suppose I'd say from a fundraising economic standpoint at the moment, there's always been a difference between the US and UK. The one thing to note is if you're trying to raise US monies, you have to have at least a founder based there full-time properly, and that's the mistake people try and do is they try and go, I'll go to the US and I'll raise money, and they think it's the nirvana that will give them money. Unless you're based there properly, nobody's going to give you money over there.
And you need to be incorporated in the US.
Yeah, there's all sorts of Well, occasionally they do, but you have to have a proper presence. You need to be there. It's coming back to this different model. It's they are the models I'm talking for. The US model is the portfolio play generally. The UK model is our whole portfolio will perform. So again, it's worth thinking at. So when people go and talk, this is great, it's got bigger valuations and everything. Well, partially it does because it's a bigger market and you're talking about a bigger market size. So when you talk about your end reward, it's bigger. But also because there is, in this model, there is sensitivity, don't get me wrong, about valuation, but it's a little bit less sensitivity because if one company does 100x or 1000x, that outweighs what value they went in, so they can be a little bit more flexible. It's more about trying to identify those companies. It matters more with this model. That's not me saying go over here because you'll get better valuations, because we were talking about before, your valuation is irrelevant until you sell a part or all of your company. So actually, if you think this model means you're going to go bust and you're going to be one of those ones that succeeds, then actually what's the point of you having a better valuation, because it's never going to mean anything. You need to sell at some point. So again, that's where you're trying to align. If you're going to go and move most of your operations to the US and open up an office there, that's fine. A lot of investors will be cautious around that because every company comes to them pretty much going, and one of my future opportunities is the US, and very few companies actually go and manage to properly go and establish in the US. So they've seen that before and they get nervous around that to an extent. There are some funds who specifically, though, will invest at A/B stage to help people with US internationalization. And coming back to the value add, they'll say, we've got a US office over there, or we've helped 20 companies do that, so we know we're the experts and we'll help you. Again, I'd argue that you're better to hire in the expertise to help you do it, but still, they will give you money for that purpose. I suppose the challenge in one sense is, if you moved everything over there and you've got a tax-efficient investor, you could prejudice that depending on what you do. But at the time, take advice, because as long as you were having some board meetings and things over here, and you probably employed somebody, you'd probably still be fine for that. But that's a future issue. It doesn't. You raising money over here doesn't necessarily preclude you going over to the US. I suppose it's just.
Or any other market.
Or any other market. It comes back to it. Investors want you to be as valuable as possible. So when the time's right, if you've got a model that is replicable in the US and in Europe and in Asia, obviously go and do it, because all the most successful companies are global. But it comes back to finding an investor that would agree with that. But actually what's more important of all of that is, what are the rights? Do they have a right to stop you expanding to the US? They'll have certain rights over things you can and can't do, but actually they may not have any actual technical control and power to stop you setting up a US office. So they might shout, they might get annoyed in a board meeting, but if they don't actually have any power, there's nothing they can do technically. Being aware of your own markets goes without saying. What I'd say right now is quite a good time to be raising. Talking about the economic situation, one of the byproducts of it is all your traditional places of storing money aren't really making really good returns at the moment. So you might have gone and put some money nice and safe in a government bond. It's not doing it. Well, actually, there's this thing that gives me 30% back, and actually I'll go and pour some money over here, and actually they're offering much better return anyway, even though it's high risk. So there's a lot of money has gone into venture capital and private equity recently. So they're all sitting on a pot of cash. They only make money if they deploy that cash, otherwise they need to give it back to their investors. So now is quite a good time to raise. With everything that's happening everywhere in the world, I can't definitively sit here and say it's the same in 12 months. It might well be, it might not be, I don't know. Now is not a bad time to raise. That's the only thing I'll probably say on that in terms of kind of macro factors. I mentioned it briefly before in terms of more mature businesses selling, and whether it's private equity or whether it's trade buyers. Private equity are currently, not all the time by any stretch of imagination, but private equity are beating trade buyers more than they historically would. And that's a sign that they're sitting on cash they need to deploy it, and they're acknowledging they're not going to make the same returns. I was speaking to an investor, and he was saying they make money in two ways. They make money by taking fees from the money, so take it from their investors, and they also take it from the company. They take fees that keep the lights on, they make money out of that. They also then make money if there's a good return. There's something called carry. I won't get into all that. He was saying his fund is acknowledging that actually right now they think in the future they're going to make more money out of the fees than they will out of the carry, because they think they're going into high valuations on stuff and they're not going to be able to sell it in 5 years' time for that value. But that's the decision they made, so they're just trying to pump more money out the door so they get more fees that pays them still at the end of the day. So that's a scenario that's happening in the market at the moment. Is that sustainable? Question.
A big round of applause.
Thank you, everyone.